SaaStr isn't a conference, it's a community. That's a great vision.
If it's helpful, I'll share my thoughts about where we are. Obviously, last year, things were easier for most folks than 2021. There was still so much budget going to SaaS and cloud. Those days aren't coming back. I want to talk about how things are different this year than a year ago. Last year was challenging, but why are things so different in 2023 than 2022? This is the first time in the last 10 years that SaaS has gotten harder. This is from the BVP Cloud Index. The overall growth of the markets, and the top one is all the public cloud stocks and their stock prices. There were a few bumps, and if you squint, there was a flash crash in 2016. And it was worse than anything other than 2008, 2009. For about 4 months, people stopped buying anything in SaaS. It was so crazy that LinkedIn, even though they were profitable and public, panicked and sold to Microsoft. Like the market's panicked, okay? The weird thing is now we're in year 2 of a tougher cycle, year 2. And I put this up, 2011 to 2016, outside of that bump, SaaS went from really hard, but each year got a little bit easier. People knew a little bit more about SaaS. And then Box went public in 2015. And then between about 2016 and 2018, after that little crash came back, everything got easier. It was always hard, but it just got easier. Deal sizes went up. Folks that used to know how to sell a product for $3K could figure out how to sell it to $10K to more stakeholders, and more budget opened up, and SaaS went from weird to mainstream over these years. Then right before lockdown, it got pretty good. There's unicorns. HubSpot IPO was worth $800 million when Box IPO was worth $900 million. Public companies weren't even unicorns back then. All of a sudden, startups could be unicorns. And so it started to get easy. And then 2020 and 2021, it got to almost too easy. Everyone needed a call center, they needed e-signatures, they needed to collaborate, and it was crazy. And so be it. We know that was a unique moment in time. Then we got to 2022, and 2022 in some ways was terrible because it was a huge overhang. I had invested in sales off almost pre-revenue. They got bought for almost $2.5 billion in cash, and it closed December 31st, 2021. And they just crossed a little over 100 million in revenue. Deals were being done at really high multiples. It was like 20x, which seemed like a lot today, but then it actually was a decent deal for a PE workout. And so 2022 was crazy. By about the end of Q1 of 2022, the D and the C's were gone. Then the B's started to fade away over the summer as the valuations plummeted. By the end of last year, A's disappeared. Okay, and I actually don't think very many SaaS Series A's are happening. Now we're in what looks like a flat turn. There's a handful that are more than 10x, the Snowflakes and Cloudflares, HubSpots, but the average, it's about 5 or 6x. I don't think it's so hard. It got as hard as it should be. If you do something better than Salesforce or Zoom, or that is 10 times better, you will get money, but it's because things are down overall about 30%, or growth is down by about a third, but growth is not down 100%. It is down by about a third from when it's easier. So everything's 33 to 50% harder. Here's HubSpot, and HubSpot, they just crossed $2 billion in revenue. They wanted to invest in sales and marketing and engineering and product. Their net margins were pretty low. They were positive back to 2017, but they weren't much. They were investing almost everything back in the business. And then look what happened over the last year. Radically more profit, from almost nothing to 13.5% margins. HubSpot is radically more profitable than it was a year ago. Monday.com is crazy. It's growing 50% at $640 million in ARR. Pretty good. But look what they did on the left. Here's Monday's headcount. Grow, 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 and then they held the headcount flat, but they grew 50%. They had tons of money, but then the world changed. Monday became radically different, from minus 16% margins to 24% in 1 year. 24% is really hard to do. Now again, this is non-GAAP. I'm not going to get into this in a short session. Maybe for the first time ever in SaaS, efficiency actually matters. I mean, we just all have to spend 33% less forever. Monday, HubSpot did it in 1 year. Everything's going to get 33% more efficient and maybe 33% harder. Quotas will have to actually be met. Everything will have to be more disciplined. We're coming into 18 months into this change. It's a reflattening. It's doing more with not that many more people. ChartMogul just put this together. I thought it summarized a lot of things briefly. They tracked the overall growth of from 1 to 30. Their top quartile in 2021 hit 100% annual growth from 1 to 300. If you double at this rate, it also means roughly you can raise venture capital. Roughly at this rate, triple, double, If you're doubling, you can raise venture capital. If you're growing 65%, that's still pretty good growth. You can't raise money. So one, all these companies became unfundable over the course of this year. And two, what really happened is the best ones still grew, but they grew 33% less than they did at the peak. It's not like the top quartile is growing zero. I don't have any empathy for startups that had decent growth during 2021 and have slowed to zero. Okay, you really have no customers? What it means is your product wasn't valuable enough. It means you fell out of product market fit. It means in 2021, when a director of sales had budget and can buy your product, but now the VP of sales or CFO doesn't see value, that's on you. That's not the market. Go change your product, iterate so that there's enough value. If your growth has slowed 33% since the peak, I got a lot of empathy. Everyone already has bought 200 SaaS products. No one needs yours too. Okay, most businesses out there work just fine. Do we need the 11,000th prospecting tool or the 58,000 payroll system? We do not. The tools are okay that we have today. Build something disruptive, build something amazing that will get someone to switch, and you'll unlock the budget. This version from Carta that showed through Q the peak of venture, and it's just plummeted. Capital fell 80%. If I had to give you one takeaway, it ties back to the prior founders. So like, I want to raise an A round or a late seed round. We're at 2 million ARR, we're going 40%. But last year we were growing much more quickly. It's just harder today. I'm like, I get it, but you're not going to get funded. If I had to give you one takeaway, you're not going to get a pass from new investors. Now, your existing investors may give you extra money, may give you a bridge or an extension because they understand the 33% impact, right? But new investors, they can't because you need to get to 100 or 200 million in ARR in 7 to 10 years for venture to work. And if you're not growing at a rate that can compound to 100 million in that journey, you simply can't make VCs enough money for them to make money. Founders don't get it. There's this old math, triple, triple, double, double. You got to triple after 1 million, 1 to 3, triple again, 3 to 9, then 9 to 18, 18 to 36. If you fall below that line, it doesn't mean you're a bad human or a bad startup or your customers don't love you. It just means venture capitalists can't make enough money to invest in you. And this is why the markets have frozen. I met with one of the best SaaS VCs, growth, multi-stage, 10 billion, 20 billion under management. How are you guys thinking? What if I gave you a triple, triple, double, double company? He's like, even that, we don't even know if we want to, unless it's AI, we're not even sure we want to invest today. There's essentially zero interest in ABC, SaaS VCs, or anything that isn't AI. I want to hit a couple other points. So what does Gartner say? SaaS is still going to grow 18% in spend this year and another 18% next year. People are still going to spend almost $200 million in the US alone on SaaS. Now, a lot of that's going to go to incumbents, price raises, and inflation. Okay, but it sure ain't going down. So change the world, and you can access some of that incremental $30 billion. As you can see from the Gartner data, it's not like the budget's disappeared, but those folks that could just buy your app without the CFO's approval, that's just gone in most businesses. But it's just like it used to be. The biggest challenge through the rest of the year and into next year is really just revenue multiples. Everyone needs to be an expert on multiples. There has been a bit of a bounce at the end, but some folks in the stock market call it a dead cat bounce. When the market drops a lot, like it may bounce off the bottom, but it doesn't mean that it's such a big bounce. Until the average good public SaaS company is above 10x, there's stress. It's almost impossible for late stage investors to make money, right? If the average public company is doing 300 million and trading at $1 billion something in revenue, who's going to do a unicorn? There's no room to make money. You've got to triple your money, at least as a late stage investor. But will we stay in this world? It's a world where you can be efficient and profitable, but it's hard to raise capital. So that was my last point here. Don't be waiting for a rebound. We're 18 months into this reset. Let's hope for better. I do think as an optimist, multiples will be higher. I do think buyers are still there, but we got to plan for more of the same. So if a rep wants to make 150 grand a year, you better close 5 times that, mid-market 4 times, SMB 3 times. Otherwise, they're not efficient enough. Sales has got to get back to real world numbers that assume every round is harder. It's supposed to get harder as you approach the value of a public company. It's very hard for investors to make 3 to 5 times their money. It should be. The third point, you can't just cut. And public companies know this. Layoffs were brutal for public companies, but the good ones did this thing of precision. HubSpot did some layoffs, but it wasn't that much, and it let them become radically more efficient here. I think they did 10% revenue faster than your expenses always works, but just cutting solves no long-term problem. You've got to still do marketing. Everyone that cut marketing to zero, in the beginning of this year is going to have no pipeline at the end of this year. Everyone thought the marketing was dumb. Field events were dumb, or webinars were dumb, or podcast ads were dumb. You can't just cut your way to growth. But to be efficient, for every dollar in new revenue, instead of spending 2 times what you bring in, spend 75% of it. You never fail if you spend most but not all of your new bookings. And then my last couple points, you see everyone's talking about AI in the Bay Area. Only thing anyone is interested in the Bay Area is AI. They don't want fake AI. What they really want are companies that can grow at insane rates because they displace human beings. They want companies that can go 1 to 10 to 100 in 2 years that will just replace hundreds of jobs. That radical efficiency. And then the final point, this year was the slowest year so far for SaaS IPOs. There are so many SaaS companies at 200 million and above waiting to go to IPO. Canva announced this week that they crossed 1.5 billion in ARR, profitable for 5 years. I mean, just sitting waiting to go public at 1.5 billion, right?